Start.
Welcome everyone. Welcome you all to our biggest investment event of the year, Masters of the Street Conclave. While we welcome our masters, let me talk to you about what is Masters of the Street. To democratize investments for all our clients, we launched Masters of the Street for all our ICICIdirect customer in 2021. While Masters of the Street, we aim to offer ready-made equity basket managed by leading investment experts, that is our masters. Masters of the Street offer equity basket across wide range of themes, style, market cap, with aim to generate long-term wealth for our clients. For our clients, this offering is available on our website and on our apps. With the Masters of the Street Conclave, we aim to bring to you our masters under one digital roof with our 2 days conclave. Starting today, we are going to have two topics. One, growth or value, which will be more rewarding over the next decade. And the second one we are going to have is overcoming behavioral biases during investment. And without delaying any further, let me introduce our first master of the street, Sunil Singhania. I think I don't need to give too much introduction for Sunil, but let me make an attempt. Sunil, founder of Abacus Asset Manager, very renowned fund manager, chief investment officer at Nippon Asset Management Company, the way we know today. But earlier, during his stints, it used to call Reliance Mutual Fund. And what a career he had there! It's amazing, right? He made that assets grow to $11 billion during that period. A CA rank holder, CFA charter holder, and his investment philosophy focus on generating alpha through fundamental driven bottom-up stock picking, and he's known as one of the best stock picker of the street. A big bull of India story. And welcome Sunil on the Master of the Street. We are proud that you are there, and we really love for you to join us today. Second, another very good friend of mine and a great master, Rajesh Kothari. Rajesh, managing director and founder of Alpha Accurate Advisor. He and his team believe in motto of protect capital, create wealth. This investment philosophy is focused on long-term wealth creation with resilient even during the market fluctuation. Prior to founding Alpha Accurate, he was a fund manager at DSP Merrill Lynch. And during his tenure, the fund grown from $100 million to $1.5 billion. He is an MBA CWA degree holder and believe in making high conviction investment in companies with strong moats. Welcome, Rajesh. Welcome both of you guys. It's over a period of time we keep on hearing a lot of things, and that bring me to the first topic: growth or value. Right? We heard about a lot. We have seen growth outperforming value for a decade, and we have seen how value came back over a period of last 1 year or so. And it's very important for us to really understand how this entire concept, value and growth works. And Sunil, to start with you, can you explain our viewer what is growth, what is value, and how do you really differentiate between the two?
Sure. Thank you, Bharat, and thanks ICICI Securities for giving me an opportunity to interact with so many investors. It's always a pleasure, and this time it's a real pleasure because as we speak, we are almost at an all-time high as far as the Indian markets are concerned, despite what has happened in the world in 2022, and despite all the challenges and all the concerns which all of us had. Coming to the specific question on growth and value, so I think, in the markets, at least my perspective, the last 25, 30 years of my experience, I think these terms keep on evolving. But ultimately, what is investing? Investing, according to me at least, is becoming a partner in a company. So if you have 100 shares or 100,000 shares or 2% or 5%, the extent of your shareholding. You are becoming a partner in a company. And any investor would like to become a partner in a company where what he pays today, he or she pays today, in terms of the investment, will be repaid to them by way of future profitability. I think that's a simple funda. Now, what happens is obviously a faster growing company uh, uh, has higher future cash flows, and therefore the multiple tends to be higher because you are going to be able to recover what you are investing faster. Value company, on the other hand, the way it is sort of understood, is a company where the P multiples are lower, but obviously the growth is lower. So the number of years you will take in terms of recovering your capital and post that making return would be slower because the growth rate is. I think that is a simple funda. However, in our markets, we tend to believe that a few sectors, irrespective of the underlying growth in the company, are growth. So, FMCG, for example, is considered to be a growth sector. We don't go into the details, and when you go into the details, you figure out that these FMCG companies have been growing at 10% for the last 10 years. So I don't know how they should be classified as growth, because they've been growing at lower than the nominal GDP growth of India, which has been 13% odd over the last 10 years. And some of the so-called value companies have in fact double, tripled their sales over the last 5 years, though with a little bit of more volatility. So I think this value and growth is a concept which we should understand properly, rather than just going by the primitive and the historic definition of growth and value. From our perspective, there are only few things which matter. One is companies making profit, companies growing profits sustainably, and what you pay today should be repaid by way of future profitability. So if the growth is faster, you will end up giving them a higher P, and they might be classified as growth. And if the growth is lower, you will give them a lower P, and they might get classified as value. For us, value at a reasonable price, or which is discounting the growth, I think that is a good sort of as far as long-term investing is concerned.
Thank you, Sunil. Rajesh, just to take this question to you. You always talk about growth, right? Always you say that I am a guy who really drives growth, but I'm very conscious of price, and what Sunil just mentioned, that evaluation wise. If you can just give us more deeper thoughts, because when we look at your portfolio, and and Sunil, sorry for using this term, but we have just used the P as a simple criteria that what is growth and what is value, because we also understand it is simple. And when we look at portfolio like Rajesh, your portfolio looks like 50% growth, 50% value. So how do you differentiate between the two, and how do you look at this growth and value as a concept?
Great, Bharat. So thank you very much, first of all, Bharat, for giving us an opportunity to be on this platform. I think it is a wonderful opportunity to interact with all the investors. Bharat, what has happened is that this concept of value, first it was coined by Benjamin Graham, correct? At that time, he said that any company's market cap, if it is less than the cash on the balance sheet, then that stock is a value stock. That's how we define market cap less than the cash on the balance sheet. Of course, in last 30 years, probably you will not find a single investment in the world, forget India, where cash is less than the market cap. So the formula, the original formula, which was invented probably in 1957 or something like that, that kept changing. In fact, in the revised edition of Benjamin Graham himself, he has changed the formula 10 times. Am I right? So what happens is that there is actually nothing called growth. There is nothing called value. We should not get too much confused about it. For investor, what matters is the ultimate long-term wealth creation. Let's try to understand from where the stock generates wealth. Stock generates wealth only from one factor. And that one factor, the single most important factor, is the earnings growth. Without growth, there is no life. So even if the so-called value stock, for example, a commodity stock, suppose it's trading at PE of 4, It will move up only when the steel prices moves up, and therefore the company's profit also expected to grow up. So very, very important for all of us to understand is that the growth at value is most important. You should not overpay for the growth, but growth is critical. If there is a zero growth, even if you are getting a PE of 3 times, I mean, I don't see any value in it because there is no growth in that company, correct? So what we do is that very, very consciously, irrespective of whichever sector we are buying, irrespective of whichever company we are buying into, we make sure that there is a earnings growth attached to that company what we are buying. Now, how much PE you have to pay, how much valuation you need to pay to that growth, it depends upon few important things. The first important thing is that how sustainable that growth is. For example, in a cyclical sector, it might be less sustainable compared to maybe a consumer sector, for example, where it might be a little bit more sustainable. Second important is that what kind of capital efficiency it brings along with the growth. Is it a 40% return on capital employed, or is it a 10% return on capital employed? And these two factors combined, it decides the price to earning valuation what investor needs to pay. So we are absolutely conscious about both these factors. One is the growth, and second, how much we need to pay for that growth. If it is a sustainable growth with high return on capital employed, we are fine to give PE of 20, 30, 40 times. On the other side, if we believe that growth is only for next 2 years and may not be for next 10 years, then of course the price to earning valuation are going to be lesser, maybe 15 times, maybe 18 times, depending upon every sector and every company. So that's how we look at, when we select the stocks. Growth at value is the final mantra for us when we buy and construct the portfolio.
Thank you, Rajesh. And to our viewers, if you have any questions, please use the chat, put this question forward, and I'll put it forward to Sunil and Rajesh. Sunil, you spoke about, it's not growth value, it's the cash flows, is ultimately the earning. How do you do that segregation, whether it fits your bill? Is this company, worthy to be part of your portfolio? What are the parameters you use to make sure that either you are not getting into a growth stock at unreasonable price, or you are not getting into a value trap? How do you really make that distinction so that it's stay on course? Sunil, I think you're on mute.
Sorry. So, see, it's not mathematics that, we can say that the formula and it would make life easy. I don't think either me or Rajesh or anyone would have a job left if it would have been a simple formula. So I think it's a combination of obviously mathematics, experience, view on the future, a little bit of science, psychology, global trends, etc. Having said that, I think what is important, I think one, there is no doubt, I mentioned it and Rajesh also reiterated that you need profits to grow, because a company which grows profits will keep on getting more and more valuable. For example, a company which is making 100 crores of profit is valued at X. And if that 100 crores of profit were to become 200 crores in the next 4 or 5 years, then obviously the value of the company naturally should become 2X, believing that the same growth rate should continue. However, this is one part of it, which is growth in the business and growth in the profit. I think what is also needed is how much capital is needed to generate that growth, and which is where this concept of ROC and ROE comes in. One company would say generating 100 crores of profit by using 500 crores of capital. Therefore, the ROC is 20%. And the other company to generate 100 crores of profit is maybe using, say, 2,000 crores of capital, which is 5% ROC. So obviously, the second company is using too much of capital to generate substandard return on capital employed. And therefore, for the same amount of profit, the second company would be valued at a significant discount to the first company. That's one of the parameters, obviously. The other, obviously, is the growth. The faster the growth, as I said, the higher is the value. The company, two companies making 100 crores of profit, one growing at 20% and the other growing at 10%. The first company will take 3.5 years to become 200 crores of profit. The second company will take 7 years to become 200 crores of profit. So obviously, the premium you are willing to pay to the first company, which is growing faster, is very high compared to the second company. So all in all, I think what is important from our perspective, apart from the qualitative aspect obviously would be the management, the sector you are in, the potential of the sector, the outlook of or the behavior of the management with respect to the shareholders, particularly to the minority shareholders, and so on and so forth. I think the three most critical elements, and which we capture in our 15-15-15 perspective, is return on equity, the growth rate as far as profit is concerned, and obviously a very simplistic measure, which is the P, which is to just explain or just to have a very simple kind of a matrix to determine whether the stock is expensive or not so expensive. I think if you are able to focus on these three metrics, apart from the qualitative aspect of management and longevity of the business, the credibility of the promoters, etc., I think these would be the parameters which we would use. Obviously, the world is very dynamic, and increasingly, and that is also we have added in our framework, the MEETS framework, is disruption. Gone are the days where you could buy something for 15, 20 years and forget about it. So all this concept of 40-50 PE was because these businesses could last for 50, 100 years without getting disrupted. But we are in a very different world. The way we are doing this conference is very different. Earlier, we would have done it physically. The way our kids are studying is very different. The way we are watching movies and program is very different. Or shopping, or entertaining, or XYZ. I think the world is very different, and disruptions are hitting us every single day. Newspapers we are reading, maybe our kids are not as inclined towards reading newspaper. Even TV, the only reason we are watching cable or the dish TVs of the world is to see the matches, the sports, as well as the news. Everything else is moved to the OTT platforms of Netflix, Amazon, and so on and so forth. Even on the auto side, the only auto company which has created wealth over the last 3-4 years has been Tesla, despite the fact that it has less than 1% of the total market as far as passenger vehicles is concerned. But that threat of disruption is for real. So I think that is one more element which has been added. I think this would be the few qualitative as well as quantitative factors. But again, to reiterate, I don't think investing is mathematics. It's a combination of a lot of other, traits which would be needed to come kind of a conclusion.
Great, Sunil. Rajesh, coming to you, you allocate money into diversified sectors, diversified stock, right? And as we discussed, you guys really, both of you really don't believe in either value or growth. And I think the bigger important point for you is the earning. And without growth, there is no reason to really classify a company for a growth or value, because ultimately you need a growth to really have value in the company. So the value is derived from the growth. And always the question comes is that, are you paying right price? Are you overpaying for the growth, or are you paying lower for the growth? And markets are dynamic, right? It's not predefined that because this company is going to grow at 12% or a 15% and 18%, and hence for a 12% growth pay 20, for 30 pay 40. And as Sunil mentioned, it's not math. It's an art. It's art of investment, in art of your ability to really decipher how the things are working on. So from that point of view, Rajesh, how do you look at different sectors? Do you define sectors, go, no go, or you define the sectors because they are growth or value? You recently added some large BFSI exposure to your portfolio. Is that was driven by the fact that markets have overrun and these stocks are at cheaper, or you believe the growth is coming and hence you believe they have value, or in other terms, growth at reasonable price?
Well, I think it's too many questions, difficult to answer.
So my question is very simple, Rajesh, that how do you bifurcate different sectors? And recently, when you have added BFSI, what was the thought process of adding BFSI?
Sure. So basically, Bharat Bhai, as I said, that we don't have a basket called growth basket or value basket when we buy the stock. As I said, we have a very simple and very effective framework called 3M investment approach. And I'm sure many times we have discussed at length about it. The market size, market share, and margin of safety. So our entire investment philosophy is protect capital and create wealth. So the risk management part is something very, very critical. So when you follow this principle of 3M approach, basically we select the companies with the best of the governance, best of the management, best of the financials, provided the company is market leader. And that market leadership gives resilience to the business model, correct? And when you pay on top of it at the right multiple, the right valuation, that basically brings into the concept of margin of safety so that you don't overpay. Replying to your first question, how do we decide? So we need to make sure that we don't overpay to buy that high growth, correct? Coming to your second part of question, the BFSI space, for example. So we believe that the banking system, the credit cycle, I think probably one of the biggest credit cycle inflection point has just started in India. In last 10 years, we have not seen particularly non-food credit growth. For the first time, from last 4 or 5 months, we are seeing the beginning of non-food credit growth, double-digit non-food credit growth after a very, very long time. The borrower is becoming healthier. Corporate India has deleveraged. Roughly about 1,60,000 crores has been repaid in financial year 2022. If you look at the lender side balance sheet, their balance sheet is also very, very cleaned up balance sheet. So lender is willing to lend. Borrower is now become healthy. So that basically is the right combination for both lender and borrower. And it is coming at a time when India is just about to grow from here. The worst of the, I would say, the global economy problem, the Russia-Ukraine problem, the commodity problem, the crude oil price problem, the supply chain problem, the pandemic issue, I think the worst is behind us. From here, if India has to grow 10% in nominal terms, I'm not talking about a 14%, I'm talking about only 10% in nominal terms, then it means, of course, the bank credit growth has to become 10-12%. Last 10 years, the corporate has not grown. In terms of the credit growth, corporate credit growth has been very, very muted. We believe that over next 3 to 5 years, it's the beginning of corporate credit growth cycle. And therefore, to play that cycle in a right way, we have increased the weightage in BFSI space. Within BFSI, we have added, for example, in both the portfolio which are there on Masters of the Street, to two leading banks of the country. Both are public sector banks, but both have now improvement in return on net worth as well as improvement in return on assets with the best of the asset quality probably going forward. We already have exposure to private sector banks, which are one of the largest holding in our portfolio, and they already have the best of the balance sheet and best of the ROE and ROA. And last but not least, Bharat Bhai, which I would like to emphasize is that just buying best of the things is not sufficient. As you rightly said, the world is changing very fast. And therefore, the discipline exit strategy, बेचना कभी है, वो सबसे ज्यादा इंपॉर्टेंट है. लेना क्या है, सबको पता है. लेकिन ये चीज बेचनी कभी है. When we have to reduce our weightage in the portfolio, when we have to exit from the portfolio, that's basically something very, very important. And that's active portfolio management. That's the only way to bring the, what I would say, superior and resilient risk-adjusted returns.
Thank you, Rajesh. And Sunil, I will come to you specifically for this, is that, for last 10 years, we say growth has performed. The deep value guys, and I will say, I'm not using the word now growth and value, I'm saying the deep value guys have actually underperformed. Now, and as Rajesh mentioned, is all about exit. We really want to understand, Sunil, how do you see the market? How do you take a decision when to exit? Taking a recent example of IT, PSU banks, how do you make a decision that yes, enough is enough, too much of run has happened, everything is in the price and it's time to change the theme? Is this driven by the other opportunities available, or it is driven by that company or that sector view? So if you can just, help us to understand. Sunil, I think again you have to unmute.
I think it is very tough. Frankly, it's a very difficult decision. I'll be very honest. The biggest mistakes in my life has not been buying something and messing it. The biggest mistakes have been buying something and selling it too early. So during my mutual fund days, we used to own 9% of Bajaj Finance. when the market cap was like 5, 6, 700 crore, no one was looking at Bajaj Finance. I would say luckily or unluckily, we multiplied our money 3, 4 times in a matter of 2 years. And if you remember, during those days, making returns was so difficult that this was like a bounty, and you ended up selling
Yeah,
early.
I remember your Reliance Vision Fund and all those funds.
Yeah.
Yes.
So it was, selling early. So selling is always a difficult decision. But, let us classify the stocks into 3 parts. One are structural growth. So these are companies which you want to retain for 5, 10 years because you have confidence that they will continue to grow at 15, 20% for the next 10 years. Then there are some cyclical plays, which are deep cyclical plays, like, which you buy, and these are technical, like steel or PSU banks, for example. I think the smaller ones were technical plays where the valuations had become so low, and there was a tailwind with NPAs not being there, with credit growth coming in, and a huge swing in profitability expected. And then there are something in between, which are, I would say, not structure, but where you have a 3, 4 year visibility. So these are the 3 types of stocks which you own. And you have to be very clear that, you are, which stock is in what bucket. Because what typically happens, you buy something from a 2, 3 years perspective, and then you get carried away. Like I remember, steel you buy at the bottom of the cycle. At the peak, you would tend to start valuing and projecting that this kind of EBITDA is going to continue forever, which is what happened even this time 1 year back. So, it's said that in commodities, you buy at a high P and sell at a low P, which is a very different perspective from buying a structural story, which is buying at a low P and selling at a high P. From our perspective, there are 3 reasons why we will sell a stock. One is when we realize that things are not working out the way we are expecting it. The good thing is that learning out of the last 25, 30 years and making a lot of mistakes, unless you make mistakes and lose money, you don't learn. So luckily, we have made so many mistakes that we have now become experts. And the maxim here is that don't repeat the same mistake. Make a new mistake every day, you are pardoned. You can't make the same mistake twice. So once you realize that you have made a mistake, I think it doesn't make sense to carry on. And because of the framework, I think the good thing is that your mistakes are not mistakes which are costing you 80, 90%. You realize in 10, 20% that things are not working out. I'll give an example. During COVID, we used to own a paper company. And unlike the Western world, in India, paper is still growing at 10 to 15%, and therefore it qualified in our 15% profit growth and a 15% ROE thing. But when COVID hit us, we were all working from home. Students were studying from home. And, we were scared to even touch newspapers. And our view was that the demand for newspapers, at least for the next 1, 2 years, would go for a toss. So, we just got out of that. It's another story that this year paper stocks have done very well. But I would just like to highlight why we got out of it. Because our view on that sector changed because of some events which happened. The second thing is, stocks sometimes move ahead and much ahead of the best, valuation. So that is not to say that if you have bought something at 100 and your target is 150, it reaches 150 or 160, you sell off. It is possible that the valuations are also keeping pace with the fundamentals. So you might want to read it. But a lot of times the valuations do run up significantly beyond your fair value. So in a few of our funds, we have sold like a music company which we own. It according to us, at least it still is a great company, but the valuations ran much ahead of its valuation. Or even pharma, 2021, we saw a lot of pharma companies run far ahead of their valuation because people were giving a higher P multiple on peak profits. So not only were the profits not sustainable, but the P multiples also very high, largely coming in from the fact that everyone started to estimate that this 30% growth is going to be forever. And that is where we book some profit. But it's a chicken and egg situation. It is not always possible to book profits at the right time. You might might be early, sometimes you might be late. So I think, you have to take a measured decision at that point of time. It is only in hindsight we come to know whether the decision was right or wrong. So even the decision to sell Bajaj Finance maybe at that point of time was right. But in hindsight, everyone talks about that company. But if you just go back 10 years, it was a company which no one was covering and no one owned. So hindsight makes us all wise, but this would be the reason. And the third other reason why we would sell a stock is that capital is finite. So if we have an X amount of capital in our fund and we have fully deployed it, and we come across something which is significantly expected to give better return than something which you already own in the portfolio, then it makes sense to switch. So these would be the three main reasons.
So Sunil, in that context, if you can just tell us your view on the PSU banks and IT. I think these are two completely different. One really in the bull market, one nobody wants to own.
So, actually, if you see, we are not fans of PSUs per se, because in our needs framework, M is management. And a lot of PSUs just don't qualify as far as management is concerned. And the E, as well as the other thing, is the ROC. Again, most of the PSUs don't have an ROC focus. They try to merge the social benefit with the private or the profit-making objective. Except we have a couple of public sector banks, State Bank of India and Canara Bank, on which we were quite positive. Some of the smaller banks were definitely trading bets. And we do have one or two of them in one of our funds. I think going forward, we have to remember one thing, that liability franchise is going to be very important. And technology is going to be very, very important. Because the world is changing. The order of the day. We are not now going into bank branches to deposit money or to do our banking. It is all online. And I think banks which transform themselves into embracing the new way of doing businesses are going to have the franchise of liability. And liabilities is very important because that's the raw material for any financial organization, including banks. So at this point of time, just don't buy into anything because it's a 20, 30, 40 rupee stock. What I'm noticing over the last 1-2 months is that any stock which is 20, 30, 40 rupees, the investors or the small retail investors love. I don't know the reason, but maybe they feel that the smaller stock can give them more return. And second is there is this huge momentum play going on. So, there is storytelling. So it was defense and then railway and then PSU banks and then something else comes in and crores of investors are getting sucked into it. So at this point of time, my view would be that larger PSU banks still have some room to go, but be a little careful on the smaller public sector banks.
Thanks, Sunil. And Rajesh, you are masters of the street. You run two portfolio on our platform, AAA Emerging Business Opportunity, AAA Digital India. And, you have given an outstanding return of 16.5% and 22% since inception, and generated alpha of 6 to 11% across these two portfolio compared to the benchmark. And, we spoke about so many things, value, the last discussion we had about exit. I just wanted to understand from you, how do you see these portfolios from 5 to 10 year point of view? How do you believe that these portfolios are good to run for next 5 to 10 years? And how do you really manage the style of your investment into this portfolio, and how do you really manage the risk? You spoke about the fact is that how do you really manage, in a bad time? So if you can just put together with respect to this portfolio for our clients.
So first, let me talk about the first portfolio, which is AAA Digital India portfolio. This AAA Digital India portfolio is basically entire, the portfolio is positioned towards the digitalization of the economy. This is not a portfolio which buys only software. There are many people who believe that digital means software. No, it is much, much beyond software, correct? So for example, in capital goods, it is about automation. It is about robotics. And we own, for example, companies like ABB. If it is a finance, it is about the digital banking, the digitalization of the payment system, and many more such digital initiatives. So we are holding 3-4 large banks and NBFC, which are forefront of the digitalization of the financial side of their sector. Then comes to the sectors which basically are into the platform side, which are the companies which are number one companies. Remember our approach: market size, market share, and margin of safety. So across the sectors, we are having the market leaders, and across the sectors, basically the companies which are at the forefront of digitalization. Why digitalization is a very structural theme? Because in India, the digitalization part of the economy is roughly about 12, 13, 14%. And that 12 to 14% is expected to become 25% over next 4 to 5 years. It means they are going to grow significantly higher than the underlying economy. So if the economy is growing at 10%, and if the corporate India delivers, say for example, 12, 14% compounded profit growth, then the companies which are on the digitalization of the side, probably they will compound at a much faster rate, maybe at 18%, maybe 20%, maybe even 30%, depending upon the different sectors. So this entire portfolio is positioned towards buying such companies which are market leaders in their own sectors, and at the same time, they are the biggest beneficiary of digitalization of the economy. As Sunil has said previously, that right now what we are discussing is through Zoom. So the world is disrupted completely. And the disruption pace, the speed of disruption is increasing every day. Whether it is a banking, whether it is insurance, whether it is a robotics, whether it is a automation of the processes, whether it is a process equipment plant for a power company, whether it is an operating plant sitting at your home, and many more such things. I think we are going to see more and more digitalization over next 5 to 10 years. And therefore, this portfolio is going to invest into the companies which will compound the wealth significantly, probably better than the underlying GDP of the economy. So that's our first thematic structural theme portfolio.
So Rajesh, kya na, all this part, na, we and I understand this. Investor asks very simple. I don't, and you, all of us can't say what will be the return in 1 year, 2 year, and 3 years, because it's very difficult to predict the market. But when the customer is looking at 5 to 10 year kind of a horizon, so as you mentioned, can I take this point at the home that if our nominal GDP growth is going to be say 12 to 13%, 6 to 7% growth, 5% inflation, which makes it 12 to 13%, this portfolio potentially can generate much superior return, maybe 1.5 times of what you do.
Absolutely, that's what we are basically aiming for in both the portfolio.
Okay, great, thanks. Coming to you, Sunil, and we are lucky to have you as well. You run 2 portfolio with us as well, just like Rajesh, and both your portfolio, your Smart Focus Alpha portfolio and your Smart Build India portfolio, and your Smart Build India portfolio generated almost 11% alpha over the benchmark, and it's been really doing well. And there again, the question here is that both your Focus Alpha and this themes on which you're investing will outperform or create performance over a long period of time, and what is your view in terms of what kind of return our clients can expect in this? So sustainability of these themes of what you are really running with us, and what kind of expectation the client should have.
Bharat, if you actually see, the first portfolio we on your platform was the focused fund, and largely, I think the way the fund or the flexi cap strategy, the way the fund is structured is we restricted ourselves to investing in the top company predominantly. And again, the thought was that it was a new platform. Our view was that we were doing it for the first time. ICICI was doing it for the first time. And the investors were also coming in for the first time. So we did not want a strategy which is too volatile. And frankly, it was launched towards the end of 21, where valuations, particularly on the smaller stocks, were crazy. And therefore, we wanted to start with a more stable kind of a portfolio, which is unlike our style, but that is what we have tried to do. I think the portfolio has been pretty okay. It generated 16.5% return for 12% vis-a-vis the 12% by the benchmark, but comprising of really sound companies. I think as we move forward, as this platform becomes a little bit more adaptable, the initial teething problems are now all behind us. I think it would make sense to add a little bit of say smart alpha into the portfolio. Unless we are able to generate a 4-5% return over the benchmark in this portfolio, I don't think we need to exist. But we have to remember that these are solid companies, large companies. The other portfolio was a technical portfolio. We could see the capex coming in, and this was a great platform where you are able to very quickly launch new portfolios, unlike an AIF, PMS, or a mutual fund, which might take time. I think, and that is the reason why we started with the second portfolio, which is the Build India portfolio. That from now for the next 3-4 years, we see a lot of capex happening. And I think that portfolio has done very well. I think absolute level, it's up some 26-27%. And if you see the composition of the portfolio, it is predominantly, industrial, which is like 65%. And the other parts of infrastructure, like a little bit of banking, little bit of telecom and all, are part of it. It's a mix of large and small cap. So I think this is a portfolio which is obviously going to be high return in a phase where capex is happening. At the same time, because it is focused on one theme, the volatility can be pretty high. But I think the platform is a fabulous platform. We are now 1 year into this platform. We have got the experience. I think going forward, this platform will allow us to come out with really niche areas. But as of now, both these portfolios are well positioned. And we are not big churners, frankly, and I think maybe investors in this kind of a structure look at more churn, but by nature, we are not big churners. But as I said, we'll add a little bit of smart alpha to the portfolio.
Thanks, Sunil. And I will take now liberty to really take questions from the audience there. And the first question itself is so interesting. They are asking you to select one theme which you believe my customers should invest. So Sunil, between two of your strategy, which one you will like our clients to invest? And I think the same question for Rajesh as well.
So I think at this point of time, Smart India looks set, largely because, as I said, it is focused on a theme which is, at least for the next 2-3 years, looking very, very strong. The only one disclaimer is that, as I said earlier, it can be a little bit volatile. But what we have tried to do in this portfolio, the theme can be volatile, but the stocks are very strong and sound. So if you see, even within the Build India, we have very large companies, Schaeffler and ABB, and so we have tried to balance the volatile sector with very sound and stable companies. So I think between the two, at least for the next 3 years, this portfolio can generate a higher alpha.
Thanks, Sunil. Rajesh, which one you select?
Well, I think, every investor is a different risk-reward mandate. But if you ask my personal view, both are my children, both are equally good. In both the portfolios, we have market leaders.
The question is, which one you select? The question is very simple. He's asking for each of you, एक portfolio बता. I don't know two.
हाँ, but अभी investor है, उनको तो दोनों पता है ना. So I know
उनको दोनों
you
पता है.
know two and even he knows two. Am I right? So see, important क्या होता है ना? When you are selecting a portfolio, ये question बहुत very important question. But why this question? Because you may not be knowing the underlying portfolio characteristics. So I'm just giving you one important attention to you. Is that in both the portfolios, we have market leaders. In both the portfolios, we have the companies which are debt-free companies. In both the portfolios, we have the strong earnings growth. In both the portfolios, we have a high margin of safety from valuation perspective. And in both the portfolios, we have a strong return on net worth. So both the portfolios are aligned. You can toss the coin and you can answer the question. But if I would have been you, I would split money in both and invest into both the products.
Yeah, it's very political question answer. Customer wanted one. Sunil put his heart out and said, "Okay, take Build India." You are saying,
"Okay, you are advisor, so maybe you can advise him better than me."
No. I'll take the next question. And again, Sunil, the question is that how do you arrive at the company to select and research on it further? So, is there any framework which you use?
I think इसके लिए तो 3 महीने का एक सेशन रखना पड़ेगा.
Yeah. So okay, I will answer for Sunil and Rajesh. Both of them have a very strong system in terms of the process, how the stock falls into the universe, how it qualifies for the universe, how it gets drilled down. Both of them have their own investment philosophy. Each company need to fulfill those criteria before they come in. Obviously, both have that leeway of 10-20% of the portfolio, which is what Sunil also mentioned, is cyclical, but it's a tactical one. But beyond that, the companies really need to go through that entire grilling of the entire framework, which both of them follow. Just the particular question, and I think this is very interesting, is the IPOs, right? A lot of guys have lost a lot of money in the IPOs. So the question here is that whatever style of investing you are following, will you be comfortable buying the listed space, listed universe, where you have a good history, you can go back, do the testing on that data, their credential of the management, or you guys are also comfortable with IPOs? So maybe Sunil.
I'll go first, and then Rajesh can add it, because this is something which is close to my heart. So I'm a big Bollywood fan, and I always say this, that we all know that some of the old movies are masterpieces. I like a few movies like Sholay is very, very old. The new guys will not even know it. But there are other movies which are like really, really all-time classics. But by nature, we always want to see a new movie, because the old movie tends to get boring after a point of time. And we know that the new movie is going to be 90% probability of being a very rubbish movie, but still we do it. I think IPOs to some extent are like that. There are so many great stocks that are listed, and as you rightly said, which have a great history. But the lure of something new is so high that we get sucked into it. And actually, if you see 90% of the IPOs after 1 or 2 years trade at a discount to their IPO price. Having said that, some of the IPOs have given great returns. And I think that is where proper research and insight should go into it. We were very lucky in 2020 to have latched on to a couple of platform companies. It's public knowledge. We made a lot of money in Mobile. We made a lot of money in East My Trip. Post that, I think the valuation of some of the IPOs have gone through the roof. As you rightly said, the history of companies which have gone IPO is not as deep for us to take a very learned opinion. In fact, we go by the projection given by the company as well as the investment managers when we go into the IPOs. And more often than not, we go by the grey market premium before forming a view of whether the IPO is good or not. Or some anchor investors, some anchor investor, good anchor investor is there, and we all pile into it. My view, frankly, over the last few months has been to look for IPO. They are taking too much of our time without any major, addition to the return. But one-off, we keep on coming out with good IPOs, and where we believe that we want to stick with that company from a 3-4 years perspective, and even on listing we would be buyers. I think those are the IPOs we typically subscribe. So my view would be, don't blindly follow all IPOs. And within the IPOs, there might be few which would come out to be great, but have a fundamental perspective to it. Just don't buy it because some of the so-called smart investors are buying it, or because there is a lot of hype, like what happened last year with a lot of these, new age IPOs.
Great. So I will take next question, and this is more Rajesh. How do you estimate a 10-year earning growth for any company? Do you use any tool or widely used framework? Because you say its growth is there, but how do you know what is going to happen in next 10 years?
Very, very, very good question, and very important question. We are very clear that we don't have capability to predict 10 years growth. So let's not fool ourselves by saying that, oh, I can predict 10 years and then I can make DCF model and then 40 साल का DCF लेके आज NPV बना दूंगा. Life doesn't work like that. Yesterday's blue chips are today's red chips. 75% of Sensex has changed in last 16 years. There is not a single company in Dow Jones today when it was formed, So the moral of the story is that let's be clear what we know and what we don't know. So what we try to do? What we try to do is that try to predict next 2 to 3 to 4 years, And of course, we all are here. We keep meeting management, keep doing our due diligence. So Once you complete 1 quarter, 1 year, 2 year, again you revisit the next year, correct? So it is not a portfolio where you just buy it, fill it, forget it, shut it. That Hero Motor formula of bike. It doesn't work in equity. It no more works in equity. It has never worked in last 60 years, and it probably not work for next 60 years. In fact, things are changing so fast now. So we don't try to predict 10 years. We try to predict next 2 to 3 years. But importantly, what we need to see is that what are the various growth drivers? And do we see the growth drivers, they are becoming propellers? Are they going to faster the speed of growth? Are there tailwinds to the growth? Or whether there are headwinds to the growth? And what kind of a management capability is there to execute and to capitalize on the growth opportunity? Let me give one example. When the PLI schemes are going on, government announced the Make in India initiatives. Not every company can do PLI because every customer is not comfortable with every contractor. So there are only few companies in India where customers, global customers are telling these companies in India that I'm ready to give you order. Please make an investment. I will do complete buyback from you, kind of a contractual arrangement. Am I right? So the opportunity is big, but how many companies have a capability to execute that opportunity? That's very important. And likewise, you keep doing deep dive into the business models so that even if you go wrong on your growth estimate for a quarter or for 2 quarters or 3 quarters, pandemic or Russia, Ukraine or crude oil, you don't get hurt too much because there is just a question of time. Maybe after 2 quarters, again, as things improve, as the economy again starts coming back to its normal course, the company will again deliver the earnings growth. So that's how what we try to do to arrive at the growth as well as the final selection of the company.
Thanks, Rajesh. And I think this question, Sunil, you'll love it. This is what I think you have been talking about. This is that some fund managers are willing to pay high valuation for quality companies like Asian Paints and HUL of the world. Is it a sustainable way of investing? And will these portfolio experience a time correction over the next 5 to 10 years?
So, I think you're right. I had written something on this lines a couple of years back, which was titled Bubble in Quality. First of all, I think every portfolio manager or a fund manager would have his or her way of investing. And frankly, a lot of them have been very successful, and we should respect the philosophy, the strategy, the style of every portfolio manager. Having said that, I think my view is very clear. I would buy the stock of a company, which if the whole company was available to me, I would buy. Then only I'll buy the stock. So to put in simple terms, you mentioned the paint company. Suppose you had 4 lakh crores in your bank account, Bharat. If you woke up tomorrow morning, जी और लक्ष्मी जी बहुत मेहरबान हो गए आपके बैंक में 4 लाख करोड़ है. And I came to you and I said, buy this best brand in India, and you will get very excited. And when you dig deep, you see that they make 4,000 crores of profit with an annualized growth of 10-11% over the last 10 years, which is lower than the nominal GDP growth of the country. So I think the general perception is that these companies are growing at 20-25%, which is not a reality. So I think you have to dig deep into it. And then when you realize that, will you buy the whole company and part with your 4 lakh crore? If the answer is no, then why would you buy stock of it? So again, I have learned and studied also, the best company is not necessarily the best stock. We are here to buy good companies at good prices, and good companies at good prices are good stocks. The best company trading at the best price is definitely not a good stock. We have seen, if you go to into the history of capital markets globally, and I think that is something, if someone wants to read, they should read that. In the 70s also, in US also, you had this concept. They also had this Nifty 50, where companies were trading at 70, 80 P multiple. And for 30 years, those companies gave zero. Even in India, if you dig deep, there are so many companies which over the last 5 years now also have given you zero. You just have to go deep, And then you also compare with the global companies. The largest paint company in the world trades at a 1/3 valuation of the best company or the largest paint company in India. with a higher ROE and a higher growth rate. The sector is going to be more competitive. Disruption is the order of the day. We as human beings are open to experimenting, with new brands, with new stuff. If you look at your own daily routine, you're not fixated to buying only one brand of shirt or one brand of shoes or one brand of eyewear or one brand of watch. We want to experiment. We want change. And I think that is what is life all about. You can't have a year view on a particular company, and therefore this kind of valuation. And Rajesh touched upon the fact that you can't predict for 5 years, 2 years, 2 quarters. How are you going to predict that this company is going to grow at 5%, 10% for 50 years and then do a DCF? So my perspective of investment is a little different. But at the same time, as I said, different portfolio managers and fund managers would have a different style. And all of them have great intelligence and aptitude. And I would say that all of them hopefully will do well over a period of time. I think it's for the investors to decide what they need to.
Thank you, Sunil. There are some more questions, and I will just take one more question, which is basically about China plus one story, India manufacturing story, and I think India story. You are also Build India story with Sunil. You are also playing. Rajesh, you also have some exposure to this, and maybe for Rajesh, your view on China plus one story. Do you really believe this entire chemical, specialty chemical segment and all can become such a large one, or they will remain, a much smaller portion? Obviously, they've given an extraordinary return, but will they really generate that kind of a portfolio return for us going forward? And China plus one story can really that play such a big role.
Yeah, absolutely. So we strongly believe that not only China plus one, add to that now the Europe plus one. So both combined have a very strong, potential for India. The reasons are very obvious. One, of course, the global customer wants to diversify, beyond China for his own risk management perspective. Second, India has taken a number of steps, number of reforms to make it becoming more competitive, be it a turnaround time at port, or be it, the policy initiatives, the labor, the power, the cost of electricity, and many more such steps. Third, very important, that till now China was dumping to the world, but China is also increased its own pollution norm standards. So their cost is now becoming not that competitive compared to 10 years back when you used to compare India versus China. And last but not least, there are fields like specialty chemicals, auto ancillaries, capital goods. These are the sectors where India has a very strong talent. Let's not forget that. And India has already proved as a reliable supplier to the world in textile, in pharma, and in software. So globally, people know about India delivery. The capability, the reliability is absolutely very, very high. The market share of India in all these fields, whether you talk about capital goods, whether you talk about auto ancillaries, whether you talk about specialty chemical, is significantly low compared to China. So even if there is a 1, 2, 3% shift from China to India, which in my view is already happening, I think Indian companies can grow at 30, 40, 50%. I mean, probably they can become, 3 times in 5 years or 7 years in terms of their own scale, in terms of their own profits. Now, for example, we have one company called, Craftsman in one of the portfolio. It's a company which is into auto ancillary. And right now they are supplying to the Indian companies, the European companies who have set up their plants in India. The tractor companies in Europe, they have set up their plants in India, and Craftsman is supplying to them. Huge inquiries in last 1 year, and huge traction, and they are going to see more and more order books. So what I'm trying to say is that this is already happening in real times. This is not a somebody's just a forecast that it will happen. If you talk about companies like Schaeffler, they already announced 1,000 crore capex to shift the lines from Germany to India. If you talk with Timken, they also announced additional 700 crores of capex. If you talk about Schneider, they have talked about 2.5 times increase in capacity. If you talk with companies like SRF, the current gross block is, I think, 12,000 crores, and they are doing capex of 12,000 crores over the next 3 years. So I think China plus one and Europe plus one are real growth opportunities. Of course, one need to be very, very selective because you should not buy commodity chemicals. You need to buy really specialty chemical, but the opportunity is huge. And I think it is just not the 2 quarters opportunity. It is probably next 3 to 5 years opportunity.
Thank you, Rajesh. And quickly, I will ask for 1 minute from each of you. What is your final message to our investor? First, to you, Sunil.
So I think, see, one thing is very clear, Bharat, that earlier, this 20% move in the market is to happen once in 3 years. I think now we have to brace ourselves that these 15-20% moves are going to happen twice a year. So the whole world is going to become more volatile because, as human beings, we are more connected. We get the information at the same time and we want to react in the same direction at the same time. And therefore, volatility is here. At the same time, if you look at India, I think I am very optimistic and I have always been. So, you can take my view with a pinch of salt. But 25 साल से मैं positive हूँ तो health भी बना है, wealth भी बना है. And I am very sure that if everyone follows that, they would also enjoy the fruits of it. But our view on oil, if you remember, last 6-7 months has been of oil coming down to 60-70. Even when global majors were talking about $300 a barrel and price had run up to 130, we were very clear we are not economists or oil experts. But by way of just observing some normal things, our view was that oil should be around $60 to $70. We are already close to 70. And I think that is going to be a big positive. Rajesh mentioned about the huge manufacturing shift. I think even if a little bit of shift comes and government has done quite a lot, I think government can do significantly more to make India a much more vibrant place as far as manufacturing is concerned, but that is there. But, we are beneficiaries of 4 Ds, which I call it. One is democracy. I think the world saw in 22 countries which don't have democracy like Russia and China, how can they be threats? And I think the importance of democracy cannot have been more highlighted than in 2020. Demographics, again, a young population right till 45-50, because it's the country where consumption will keep on growing. Third is domestic economy itself. When the world is struggling and we are talking about recession in US and Europe, in India, we are debating whether India will grow at 6.5% or 7%. There they are debating whether they will grow or degrow. I think there's a big difference. And the major reason is the D, which is domestic economy. We are 80 to 83% domestic. And the last thing is what we could not do in terms of building a physical infrastructure. I think this digital infrastructure which India has been able to build, including the UPI and now the digital currency and so many other things, the cheapest data network in the world and so on and so forth. I think that is going to be a big, big positive for India. I think with all these Ds in place, I have no qualms in saying that equity will be the best performing asset class for the next year.
Thank you, Sunil. Rajesh, your words.
Well, I think, just extending where Sunil ended, I think the volatility is going to be there. The important is that if you can take advantage of volatility, that's the best. If you can't take advantage, don't worry, just relax, because aaj upar hai, kal niche hai, fir wapis kal upar aayega. So don't worry too much beyond a point. And, apna time aayega nahi, apna time already aa gaya. You look at the world market and look at Indian equity market, who would have thought if last 31st December, if I'd have told you that Russia-Ukraine ka war hoega month of March mein, everybody would have sold up everything. But today, look at the markets. Market is at only all-time high, correct? So beyond a point, don't think too much. Just keep patience. Make sure that you have invested in good companies with good managers. Make sure you have a long-term time horizon. If the volatility is there, take little bit advantage of it. Jo bhi advantage le sakte uska utha lo. And just keep calm. That's very, very important, because I think we all are now over-connected. We are overdosed. We are bombarded with information. So disconnect at times. If you disconnect at times, probably you might make more wealth rather than getting more and more connected, because it's like explosion of information and there is no reliability of that information. It's all like WhatsApp university, half of them are fake news, correct? So at times be calm and just keep making money and enjoy the wealth. That's what I would say.
Great. Thank you, Sunil. Thank you, Rajesh, for sparing this time and, providing so much insight into this. And I think the topic where we started about growth and value, and I think both of you just translate in first question saying that there's nothing called growth, there's nothing called value. It's all about fundamental deep dive, and I can tell you it's basically the takeaway for me. This is that don't get into any of those things. It's all about finding growth and value for that growth. If you find growth and that growth is valuable and it is, you are not overpaying for it, you are doing right thing. The point which you mentioned is that we are not gods. We can't predict next 5 years, 10 years, and it's very difficult. What we can do is what's really playing, what's really working. Is this company has ability to grow, and will that able to grow? And if there's a growth, am I paying a reasonable price? And if I'm paying a reasonable price for that growth, I will make my money. And the last point which you mentioned, Sunil, about the entire demography, the fact is that we are, a democratic country and the digital world, all this put together, and a broad story of, India story. And, we will make that superior return, and equity is the way to play. When Rajesh, apna time aayega nahi aa gaya. So I'll go with those words, and thank you both of you that apna samay aa gaya hai. So let's not worry too much and enjoy the journey of investment of the wealth. Thank you both the gentlemen for joining us. Guys, don't go away. We are going to have a very interesting next session. Now this session, if you just connect between what just happened with Sunil and Rajesh, is that we have the masters of the street. We have those masters who breathe, sleep, talk, and spend full their time only on figuring out what is investment, how do we make an investment, what is the right portfolio stock for you, how do we really do a bottom-up stock picking for you, and how do we really reflect that in the portfolio, which will give us a much superior risk-adjusted return. Now, at the same time, when you look at that part, there's another very, very important part for us is how do we react as an investor into the equity market, right? The behavior, your patience in terms of investments. Are you really able to take that volatility of the market? How do you really react to each of those situations? What are the biases you have, right? If I find I pick up a stock and somebody comes and tell me that, okay, Bharat, you picked up a right stock, I also will buy that, and then you become more comfortable, right? Because there's a confirmation bias to you that yes, what I said others have also validated. A fear factor that I'm going to lose out, how I'm going to survive, I've lost so much money, how it will work. So that entire concept of how those things will work, how do you really take this behavior, overcoming those behavioral biases during your investment journey, and how do these masters use the same philosophy, how do they overcome? It was so easy for both these gentlemen to come and talk about the fact that be patient, this, but how do they really keep that patience with them? How do they take those rational decisions while they make an investment? And to take that thing forward, we have lined up the other next two masters of the street today. Both these gentlemen will talk about how does really the behavioral aspect of this investment work, how do they really use this behavioral part of this investment journey while they do investment for us in that different portfolio. And I will like to welcome EA Sundaram and Ashish Wakankar to the panel. Good afternoon, gentlemen. Thanks a lot joining us. Let me quickly make an attempt to introduce both of you, and maybe we'll take this forward. We had a very interesting session, Ashish and Sundaram, with Rajesh and Sunil about growth and value. And what really came out from that part was the same topic of patience, investments, and all. And we thought that that's a great topic to invite both of you. So let me just quickly introduce both of them. E.A. Sundaram, as a past colleague of mine, we work together in HDFC AMC together. He is a Chief Investment Officer at O3 Securities, veteran in investment world, 31 years of experience in equity and fund management. He is IIM Ahmedabad graduate. He has managed several large funds during his career. He was a fund manager at Zurich Mutual Fund. When it was taken over, it became HDFC Mutual Fund. And he has a very interesting investment philosophy. And fortunately, today is more than philosophy. It's a temperament what we are going to talk about. So welcome, Sundaram.
Thank you. And thanks for inviting us.
Yeah. Second, Ashish Wakankar, again, very known personality, especially in the world of investment and for multiple reasons. And you will see some of those colors today in this forum. As we know, Ashish is a founder of Equipoise, a well-known name in this market for very niche investment, what he does. Trusted financial industry veteran, 30 years of rich experience in capital market. He was with Tata Mutual Fund before he joined us as head of strategy and investment business. And earlier he was having multiple portfolio management service businesses. He has successfully set up one of the most and highly profitable offshore fund management business in India with an AUM of over $1.3 billion. He is also credited with launch of SBI Mutual Fund's maiden Mauritius-based offshore fund. Ashish and Sundaram, we spoke about all this factor, stock picking, really how do you really find stock growth value, and in this entire thing, what really coming out to this entire discussion is that when we talk about these investments, right, and the temperament about investments, those biases walks in, So maybe to start with, Sundaram, if you can throw some light about, what are those biases and what are those factors which investors need to consider while making those investments.
Yeah. First of all, I'd like to formally thank ICICI for this opportunity. It's wonderful being here. See, being human beings, I don't think it is possible to do away with biases totally, right? There is an element of subjectivity in investing, and let's accept that. The idea is to keep it to a level which is not harming the portfolio. That's the point here. Now, I think biases can be overcome to a large extent if there's a logical investment process in place. And that logical investment process has to evolve according to the investor's experiences and the temperament that he or she has developed. But once the logical investment process is in place, and if we don't deviate from it, I think that helps us to overcome the biases that will inevitably creep in. That's my suggestion of how to avoid or reduce the incidence of biases in portfolio management.
Thanks, Sundaram. And and Ashish, the question to you is that now it's a digital world, right? You get so much information, right? There's no dearth of information available. It's available to all. Our systems have evolved so much, and there's so much information readily available. Earlier, getting a data was a big challenge. Those data are no more there. Now, considering all that things, there are no advantage left, either in form of a data and information. How do you explain that some guys make so much money and a large portion of the public actually end up losing money rather than making money?
Yeah. And Team ICICI for inviting me. Some strange coincidence that I complete 1 year exact to date today, that's 9th of December, of being part of Masters of the Street. I started exactly on December 9th, 2021. In fact, I opened my trading account with ICICI Securities in October of 2000. It's been 22 years of association with ICICI Securities. And then somebody had told me that one day I would be sitting here in front of you with Mr. Sundaram in front of me, and there will be 2 portfolios of mine listed over there. I wouldn't have probably believed. So first and the foremost, let me thank you and everybody for this wonderful opportunity. Though I have been mostly managing funds for FIIs or FPIs, but basically money is raised outside of India and investing in Indian markets. See, the information clutter is of course there, and you have too much of information overload. these days, I mean, some of the applications which, Sundaram would agree with me, when we came to the industry, they were priced in some few lakhs of rupees. Today, they are probably available for a few hundred rupees, a few thousand rupees. So there is too much of information. But what you need to do, in my opinion, and what I think what I'll do is I'll stick to what we do, is and I think Sundaram alluded to that also, that, you basically need to stick to a process. So let me explain what we do. I mean, we stay focused. I mean, I in fact named the company also Equipoise, which comes from a Vedic concept called Sthita Prajna. So in terms of, in times of, exuberance, or in times of difficulty, in times of volatilities, you don't sway, you stick to your core principles, and you keep, having only one thing on your mind at all times, is the cause for, or the reason why which you are there in this vocation, why you're around. Second thing that we do is, we observe, we analyze, and we invest. So what is observe, analyze, invest? Let me just explain this part to you. So at all times, actually, we are in a state of observing and seeing and trying to figure out what is happening around. So some of the, and let me give you this example by, some of the stocks that we have in our portfolio. For example, today, you see, things gravitating towards electric vehicles. We in fact have a company in our portfolio which in the past, the traditional business, they used to be in capital equipment. A new management, younger generation coming inside, and getting into the manufacturing of electric vehicle batteries. Now, this is what becomes for us an important aspect to look at and analyze a company and participate in the company. We've seen what happened during COVID. People were cooped up at home. They were not allowed, they were not able to go out. What you saw was, revenge tourism that took place. We observed this. We looked at various companies within the travel tourism and the hotel industry. We have a company in our portfolio where we have put, so it's all about, at the end of the day, and I could take back this experience of mine of observe, analyze, and invest, and stay focused. And somebody quoted recently, time in the market is more important than timing the market. So I think these three rules, if somebody were to follow religiously, and I can go back to, let's say 20 years back when I was at I recall this experience very clearly. I was at Deutsche Asset Management. We used to manage the India Equity Fund. It was the third fund launched in Japan. I used to manage that fund. So at that time, there was an Indian company which acquired, Indian steel company, which acquired a large steel company in UK. Now, we looked at the dynamics of both the companies. This was a company, the European company, which had sales which are 5 or 6x or 7x times of the Indian company, yet the profit of both the companies was the same. It basically, observing a simple thing like this, told us that the story was not about steel. The story was about iron ore and coal. The logical thing, and the company does not exist today, so I mean, it was bought over, so I can maybe liberally take the name of the company. It made logical sense for us, to this simple observation, through this analysis, to take a look at, say, a company like Sesa. Let me circle back to your question. I mean, you asked about information overload and how we go about it. The whole idea, I think, is about staying focused to your objective, following a very disciplined approach, and rather than trying to time the market, spending time in the market is what I would say.
May I add to that? You're right. You're very right that information is equally available to everybody, and you're also right that some people make more money than the others. I think the difference is, apart from what I call external factors, there are external factors in investing, and there are factors that are very much internal. Think macroeconomic factors or geopolitical factors. We have to study them, and industry trends, we have to study them, but they are really not in our control, right? What is in our control are 3 or 4 things. So your question is why some investors are more successful than the others, given the fact that information is equally available to everybody. I think the more successful investors, apart from looking at the macroeconomic and the industrial factors and what I call external factors, give more importance to the internal factors also. The internal factors are these: what I buy is in my control. How much of it I buy is in my control. At what price I buy is in my control. How I respond to the behavior of the others in the marketplace is in my control. So if we keep these in our control, buy only companies that are extremely competitive, buy companies by not overpaying for the share. If you buy even a good company at an exorbitant price, I don't call that good investing. The third is, when somebody is panicking, when the rest of the world is panicking, when there is panic, stocks are available at a cheap price. And when you buy stocks at a cheap price, then your chances of success in that investment is enhanced. So the point is how you control these four things. And these are possible for everybody. It is not necessary that only the masters should do it. It is possible for everybody. And I think the crucial difference between success and failure is the control over these four internal factors.
Thanks, Sundaram.
If you allow me to add to what Sundaram said. In fact, and here we are basically looking at individual investors. When you ask this question about how people make more money, some make more money than the others. One aspect that I observe in the market today, something I want to highlight over here. If I look back a few years, say 10 years, 15 years back, then I see that the cash to F&O ratio was, around 25%. So F&O volumes used to be 4 times of the cash volume. Today, I see the cash volume has come down to 0.4%. So by and large, I think what is happening today is people are having, and probably this could be a phenomenon which has started during the last 2 or 3 years or during the COVID period when a lot of new investors came into the market. And the one only aspect that they have seen during this market is that the market has gone up in one direction, which is up. People have not seen those kind of volatilities or the market corrections, and they've not gone through cycles. So trading has become a part, and a lot of success was seen in this period. Investing and trading are two absolutely different and two totally divergent things. Second aspect I want to bring out over here is that, and this is an observation from one of the leading online brokers who had recently tweeted, and he said that less than 2% or less than 1% of the traders today make returns which are more than the FD returns. So what is happening today, and the reason why people are making it, I mean, just trying to connect and circle back to the point that you raised, is that it is important that you invest, you participate through rather than looking at quarter 1, quarter 2, quarter 3. A company does not live in just 3 or 4 quarters. The company has been in existence and we will be in existence for years. There could be certain challenges in the short-term period. The ability should be to invest right and sit tight. The whole idea is to back the management, understand the business, invest in it, and sit through the cycles, which I think is not happening. That's also one of the reasons why there is such an returns asymmetry between some of the investors who have been successful and some of the investors who probably have not been successful. And these numbers that we see today, cash as a percentage of F&O turnover at 0.4, which otherwise used to be 25%. I think these are some of the aspects which are behavioral or discipline oriented, which are causing this divergence is what I feel.
Thank you, Ashish and Sundaram. I think, we really dig deep into that why really some guys makes money and, some guys really lose money. And the fact, what Ashish you mentioned is that it's 99-1 when you do F&O, and I think it's 90-10 when you do investment. It means that individual investors who are not guided or unguided investors, actually 99% of the F&O guys actually loses money, or 90% of actually retail investor also loses money because they really don't have that ability or time to really go do a deep analysis and do the philosophical way of investing, which means you really do deep, buy right stocks and sit tight. And then in this context, there's one very famous investor, Warren Buffett, and he made a very simple statement, right? That at the the best way to make money in equity is to be fearful when others are greedy and be greedy when others are fearful. At the same time, there's another famous investor and known, John Maynard Keynes, who said that markets can remain irrational for longer than you can remain solvent.
Yeah.
Now, the question here for the investor is that when the market is greedy, I need to be fearful. And when the market is fearful, I need to be greedy. If I'm greedy and I'm buying, and then the Keynes comes true, saying that market can remain irrational for a period longer than the solvency. Now, putting these two things together, how do an investor really make a money? So if markets are falling, should we just go and buy and follow Mr. Buffett? Or we just say, okay, I don't know how long it will be and I can be really wipe out. So maybe
I think it's a good question. Let me attempt to answer that question. I don't think these two masters are contradicting each other, right? Now, when you say the markets can remain irrational longer than you can remain solvent, you don't become insolvent by investing your surplus money in the stock market. Unless you take some dangerous, you go short in a rising market, or you leverage yourself, borrow money to invest in the stock market, then you get into trouble. But if you invest only the surplus money in a company which you know is having a strong balance sheet, the worst is that you may underperform for a while. That doesn't make you insolvent. So that is one. The second part of your question is, market is not a monolithic entity. There are parts of the market that are cheap even when the index level is at an all-time high. So the index is not everything that is there in the market. The index is a barometer consisting of 50 stocks or maybe 100 stocks. So you're not restricted to the index stocks alone. There are parts of the market that are cheap. I can give several examples for this. We have seen several bull markets in this country. Everybody remembers the technology bull run that happened in late 99 or early 2000, right? At that time, only 3 sectors did well, but things like some manufacturing companies, some engineering companies, these were completely ignored. Even if somebody had bought at the peak of the market in March 2000, some of these engineering companies, and held them for a few years, they made very good money. The second example I can give is in 2007, when the action and the excitement was only about infrastructure stocks or real estate stocks, etc. Companies like Hindustan Unilever were completely ignored at that time. So my point is, the level of the index matters less, but what matters more is the valuation and the business fundamentals of the company we are interested in buying. So putting these two together, I don't think John Maynard Keynes and Warren Buffett have contradicted each other. I think both are excellent, quotations which will help the investor.
Great, Sundaram. And Ashish, to you specifically.
No, I'll just add on this point. See, basically, when the markets are weak, or as Buffett said that you need to be greedy when the markets are fearful. How are you able to capture this gaps that are there in the market, the opportunity that the market throws up? Volatility is actually an opportunity that a long-term investor is presented with. How do you capture that? If you're able to capture that only if you know your companies well, if you've done your homework well, if you have looked at the business more closely, you would be in a position to use this opportunity to get into the market. Now, there was a time when the markets would remain irrational for a long period, but in the last decade or two, we have seen that central banks have actually removed that question mark or that aspect out by being supportive to the market. So we haven't really seen a longish period. We saw what happened during the global financial crisis. We saw what happened after the COVID. You did have if you want to say 2 or 3 months of uncertainty, yes, it was there. But what you saw was absolute a V-shaped recovery after both GFC as well as COVID. But in this period, Were people able to take advantage? Only those people were able to take advantage, those who knew their companies well or their portfolios well. So ideal situation in such a thing is, rather than trying to do self-medication, the better thing would be to either go towards mutual funds or to go towards those experts or money managers or portfolio managers, advisors, whatever, who can guide you through this entire process. Another aspect I want to mention over here is the ingenuity or the Indian creation called SIPs. If for some reason you don't know your companies, if for some reason you are not able to create your own portfolio, which is not expected from people who are not full-time into this, I mean, that's absolutely well appreciated. But the least one can do in this period is, and as Sundar just said, you're not putting in your last rupee over there, you are investing the surplus or the amount of money that is meant for investing. Now, some people could have done, and even going forward, one could do is follow the SIP discipline. I mean, just look at, we saw the markets correct by 35-36% in the year 2020, and then give a rally of nearly 80-90%. So you have a situation where in over 2 years, the market has given us, in calendar year 20 as well as calendar year 21, the markets ended up giving you super normal returns. So the point over here is very simple. It's good if you know the companies, if you're spending a lot of time reading, researching, analyzing, estimating. If not, the better way to do it is at least leave the money with some experts or mutual funds, which in turn can handle this part for you. But in fact, those people who use this opportunity, whether it was the GFC, whether it was the COVID, or various opportunities that the market keeps on throwing, the returns that have been made over a period of time have been supernormal or exuberant. So these are in cricket parlance, if I were to say, this is like a no ball and umpire has declared a free hit. These are some of the opportunities you have to take, and the best way to take them is through experts.
Thanks, Ashish. And I got some questions from the audience, and I think there are too many of them. But there was one question which was rightly actually connected to what we guys just spoke, and then as I thought maybe for a quickly we can answer this particular question from the audience before I take my next question. Is do you believe that being irrational can be of use at some time, like some irrational optimism when started deploying capital rather than safeguarding when COVID hit? When can being irrational be a boon, or what are the guards to such optimism? Maybe, yeah, Ashish.
I have a slightly different opinion on being irrational. Irrationality basically means you're saying that I was lucky. If you're swinging your bat, if it hits, bani to bani ne top bil gani. So you are saying that okay, I hit. The whole idea over here is that follow a disciplined approach rather than saying see, again, I'll come back. I'll circle back to actual data, actual fact that is there in front of us. Just see what happened or the returns that were made. Just after this session is over, just do a simple example. January 2020 to December 2021, every month just put 100 rupees on an Excel sheet and see what has happened to the returns that have been generated. Nothing else. A simple disciplined SIP approach if somebody had done, rather than trying to be irrational or trying to be greedy because everybody was fearful over there. Had he just done this investing in a disciplined manner across 24 months, he would have been far more successful. So I wouldn't say irrationality helps. Then you're moving into the domain or the zone of luck factor. We are here to remove the luck factor and try to say how a basic process driven disciplined approach can help you enhance returns and build wealth. The whole idea is at the end of the day to beat lifestyle inflation. Otherwise, the government reported number inflation today is abysmally low. But if you look at everybody's inflation today, it basically comes from the lifestyle.
Thanks, Ashish. And Sundaram, this question is for you. It's what are the common mistakes usually investor makes, and the one which one should seek to avoid you will be able to throw some light on the behavioral biases in investment decision making, right? Also, example are like, the confirmation biases, loss aversion biases. So if you can just put some more light on the things which we do as a behavioral.
Yeah, see, I don't want to sound condescending or presumptuous and say these are the mistakes that investors make. Let me tell you what I have learned from my own mistakes. And maybe the investors who are listening in this program will shorten their learning curve by benefiting from my experience of making mistakes. There have been many mistakes made. Everybody makes mistakes, and it's important thing is you learn from them. That's the desired side effect of having a mistake. I would classify 3 mistakes as extremely important and the ones to avoid. Number 1 is equate the shorter term price movement of a stock to the quality of the underlying company. The two are different things. There are bull markets when very, very weak balance sheets, very, very mediocre businesses will see a spectacular rise in the stock price. There will be times when the stock price of extremely good companies, competitive companies, very strong balance sheets and extremely clean managements will stagnate and cause frustration. The important thing is not to equate the short-term price movement of a share to the quality of the underlying company. This one mistake, I think, is crucial to be avoided. That is one thing. And I'm speaking out of experience. Number 2 is in any investment or investment product, many of the investors will choose mutual funds or PMSs, and some of them will invest directly in stocks. There is no need to try and get the maximum return at all points of time. There is no need to seek out the best. Being good is really good enough. There are good investment products and there are not so good investment products. There is no need to look at the best investment product because the best keeps changing every few months. All of us know that. So in order to, I think the investors, all of us, are better off trying to avoid, trying not to find out who is the best fund manager or the best investment product or the one that will give the maximum return. It is really not necessary. Having a collection of good products, preferably ones that are different from one another. If you have 4 investment products and one is a large cap oriented product and one is a aggressive growth product and one is a value oriented product, I think that is extremely good diversification and it helps the investor in the long run. So instead of trying to run behind the elusive best, let us focus on 3 or 4 products or 4 or 5 products that are good. This is the second mistake that the investors should avoid. And the third mistake, which is also behavioral and which is still very much in control of all of us, each one of us, is to be bothered too much about how much money somebody else has made in the stock market. I think this is the root cause of several mistakes. Most people, I've observed this, left to themselves, many people, a substantial number of people, is satisfied with a 16 to 18% rate of return from the stock market until they see their neighbor has made 25%. That is when the problem will start. And in the anxiety to beat everybody else, in the anxiety to be number one, crazy risks are taken in the portfolio. Investment is not about generating returns. Investment is about managing risks. These are, I think, the mistakes that I have made and tried to avoid in future. And I hope the listeners of this program learn from this.
Thanks, Sundram. Very insightful. And to take this point, Ashish, is it possible to completely devoid these biases? I think Sundram very smartly moved from pinpointing to the fact is that how he experienced those. Is that how to, is it possible to actually avoid or devoid these biases, and how do one minimize the same while, either creating a portfolio or managing a portfolio? and how you have accounted for such biases in your free.
Yeah, see, at the end of the day, what really matters, and I have said, and in fact, I agree with all the points which Sundaram has raised over here. The whole idea is to have a long-term approach and an absolute disciplined approach towards investing. As long as you follow that, so you could say that, you know what, I have a bias towards my discipline. I have a bias towards the process that I follow. As long as you do that, I think you are in. Secondly, and again, I'm picking up Sundaram left that, you know, people are generally happy with around 15% or 16% odd return until the time they see the guy. So it's like, bala uski kameez meri kameez se safed kaise. So till the time you see the other guy had a white shirt, you don't see it. You are happy with the shirt that you were probably wearing. But then you start feeling that, you know, you lost out on something. The whole idea is about, as Sundaram said, managing risk. It's all about generating returns to help you meet your objectives and your goals. So as long as you are doing that, I think you are home. And I just, you know, spoke about it during the opening remarks also. We follow a simple approach over here of, you know, observing, analyzing, and investing. So we are stuck. We are absolutely obsessed with our process. The process that we call, or the philosophy that we call, change at the margin philosophy. So sticking to some of these disciplines, I think, is far more important. And yes, we are biased towards that, is what I would say.
Great. Sundaram, coming to you, and you know, there are too many questions, and I want to quickly actually complete my questions, which I thought I will last you. And before I go to Q&A, you know, Sundaram, you are advising on O3 Thematic Opportunity Fund on our Masters of the Street, right? Which has generated 16% return, you know, and we spoke about so many things, right? Biases, you know, going to the companies, figuring out to the companies, how do we don't make those mistakes? Now, in that entire context, and also that you said investing is not about investing the money, but the risk, the way you manage your risk, is that in that context, you know, what kind of, you know, first, whether the theme which you are running, it's thematic opportunity, is the theme which, you know, is there for next 5-10 years? What kind of return our customer can look? I know it's very difficult to predict 1 year return, 2 year return, but, you know, 5 to 10 year, what kind of a range of return an investor can expect in a product like this, you know, so that those, you know, rationality is there even in terms of return expectation, and how do you really manage the risk in this portfolio?
Yeah, I'll take some time to explain this. See, this product, the thematic opportunities portfolio, is I'm the CIO, but it's managed by my colleague Priyank Chandra. So that's the first point. The second is it's based on two themes. One is a medium-term theme, and one is a more longer-term theme. So companies that fit into inside these themes will be considered for investment. That we believe that these two themes will play out in this country based on the research that we have done and based on generally available information. We are confident that these two themes will play out in this country over the next medium-term theme over the next 4 to 5 years, and longer-term theme for maybe a decade or so and beyond that. Now, what are these themes? The medium-term theme is focusing on manufacturing, capital goods, and development of physical infrastructure in this country. I think it's quite evident looking at the National Infrastructure Pipeline Report or the PLI schemes that are in place, that these things will play out, and there are several companies that will benefit out of this for the next, you know, 4 to 5 years at least. The second theme, which is a more longer-term theme, is the play that increasing disposable income, increasing ability to spend, that will eventually come by two things. One, by a growing economy, and secondly, a slowing population growth rate. These things will drive up the per capita GDP growth, which is presently around $2,200. We think that it will substantially rise in the next decade. And with that substantial rise, there will be changes in the spending patterns. If you know, upgradation of homes, or, you know, upgradation of the furnishings of the homes, or instead of spending a great deal of your money on food and subsistence, there will be greater money spent on, you know, education, on travel, on entertainment, on preventive healthcare and things like that. So it's seen in other countries that with increasing ability to spend, the pattern of spending will change. Even the food habits will change from basically subsistence foods to more eating out and so on and so forth. So these are the two themes that we will play. The second thing is not more than 60% and not less than 40% will be in either of these two themes at any one point of time. The advantage of a theme-based investment portfolio is that it is more broad-based than a sector fund or a sector portfolio, while at the same time more focused than a general diversified portfolio. So that's the, it has best of both worlds. Now, within these two themes, it's what is interesting is we are not restricting our choices only to the market leader or the number two. We have a space for what we call dark horses in each of these, some of these themes. The dark horse need not be a market leader. A dark horse need not be the number two, but the dark horse has a specific niche, which we think will exploit this growing trend. I'll just give you one example to suggest what we are trying to do. Let's say we agree that spending on travel, spending on holidays will be a thing that will happen in this country. So there are hotel companies which are much larger, but there is this company called Mahindra Holiday and Resort, which is part of this portfolio, which is not the number one, which is not the number two, but which is occupying a specific niche. So apart from being focused on the market leader or the strong number two, we are also focused on the dark horses in some cases. I think this is a growth-oriented portfolio where the focus is definitely on the expected earnings growth rate, while not forgetting the valuation, but the primary focus is on the earnings growth rate. I'd like to mention here that the weighted average earnings growth rate of this portfolio is more than 40%, which is significantly higher than the benchmark index. At the same time, your other question was, how do we control the risk? It is not necessary. It is not enough if we just identify opportunities. We also have to control the risk, as you rightly said. The valuation at the time of entry should not be greater than one standard deviation higher than its last 5-year average, or it should not be greater than the relative valuation should not be greater than one standard deviation, and the valuation of today should not be greater than its expected earnings growth rate based on Bloomberg's consensus estimate. So all these things are put in place, and we ensure reasonable diversification. We ensure that no single company has got more than 10% in any single stock, and we also give importance to the liquidity aspect of the portfolio. So these are the processes put in place to control the risk in the portfolio. I think that answers your question.
And what are the return expectations, Sundaram? 5 to 10 years? That is the core question.
I would not venture into that because we are talking of an equity product here. It's simply impossible to predict the return. I can guarantee that the process will be sound, that the companies chosen will be of good quality, but I cannot venture to say anything about the returns. That is, I think, something that I would not like to comment on.
Fair. Ashish, coming to you, you manage two portfolio on our platform, the Equipose Emerging Star and Equipose New India. And Equipose Emerging Star has given 16% return. Can you also throw some light on the same? How do you really, first, if you can answer, what is that 5 to 10? Sundaram very smartly decided not to answer. But the question is that investor, when he looks to invest in any of the portfolio, there are return expectation. And the reason why I ask this question is not to take a number from you, but when the customer, anybody invest in the equity portfolio, their expectations should be aligned to what they will get, rather than getting overexcited about it and looking at the past 2-year performance and then, right over it. So the idea is to give them a reasonable anchor in terms of the expected return is what was the thought. So my question to you is that how do you really take care of the portfolio building in light of what the biases we spoke about? That's the theme of this discussion today. Your risk management framework to avoid any big risk and a drawdown, and ultimately what kind of return expectation a client can have.
So there's probably a reason why you got Sundaram and me on this panel. And since he has been in the industry for a long time, and there are a lot of cues that I can take from him. I would also say that, returns, this being an equity product is and I'll try to be verbatim as what he said, is something that I would not like to venture on. But the whole idea when somebody invests in equity products is to, and every fund manager's objective is to generate superior returns. The whole effort is to generate returns higher than the benchmark. See, you mentioned about two portfolios that we have, or two strategies that we have on the ICICIdirect platform. One is the New India Opportunities, which is large and mid cap strategy, and the other Emerging Stars strategy, which is mid and small cap. So we have in fact been able to generate outsized returns in this portfolio. So since inception, and this is again a report that your team has circulated, and since inception, which is almost a year from now, that it's been good. It's been quite satisfactory. We've done good returns over here, and the reason behind that, and we've been able to do it, is because our philosophy, which is the core philosophy, which is change at margin, and our discipline not to invest in companies with businesses or managements where we have certain concerns. Corporate governance has always been on top of the mind. Having worked and having been a fund manager in some of the MNC names, and also for a long period in some of the large Indian domestic names, I have always lived and followed a disciplined approach, and have always worked towards a risk template. So risk template is something that is always a guiding principle, or it's there for you as in front of you. You put down your parameters depending upon the objective of the portfolio, so that the risk template would differ depending upon the portfolio. So for a large and a mid cap, but by and large, it's the risk framework which remains common. I spoke about the concept called change at margin. Let me briefly explain what is change at margin. Change at margin means whenever there is a fundamental change in the company, like change in the management, change in competitive intensity, change in business dynamics, change in technology, change in, for example, a company getting into a large capital expenditure, shifting consumer preferences. Now, these are some of the changes that we try to observe. And I spoke about, the discipline or rather bias towards our philosophy, which is change at margin, which drives us. So some of the things that we do over here are all related to this philosophy that we have. And our understanding of this is that whenever generally there is a tendency in the market that change, when it takes place, the result of that would be linear. In our observation, the philosophy that we follow, the change at margin philosophy, we've seen that the changes that are there in the portfolio are actually non-linear in nature. So the portfolios have been curated in a manner, particularly the mid and the small cap portfolio, to generate outsized returns, to capture this non-linearity aspect of the companies that we invest in. And as I mentioned, the risk mitigation is through a disciplined approach of always maintaining a risk template. So some of the things that we follow in the risk template would be: what is the maximum exposure to a single stock? What is the daily average liquidity of a stock? To what extent do we allow a stock to rise? So for example, and you have the portfolios in front at your command, so you can actually check what I'm saying, cross verify whether the claims that I'm making have actually been followed by us. So for example, there was a stock in our portfolio which at the time of entry was around 5%. There was a decent amount of rally capital appreciation. It went up to nearly 8 or slightly above 8% in the portfolio. We brought it down. I mean, at the end of the day, we don't know. There are a lot of unknowns outside. We don't know what are the things that are going to hit. And we don't want to be in a situation that we are caught on the wrong side and all the hard work, the efforts put inside in generating the returns are lost because you know what, we wanted to be Superman over here. So we ensure that after some time, the portfolio, the stock in the portfolio which has run up is brought to a level to our comfort. So we follow a risk template. The risk template clearly defines us to bring it down. So we brought it down. So we brought it down to close to about from 8% to about 6%. It's or 5.5%. It's back to around 6.5%, 7%. That's another. But every now and then, just because a stock has been running up to allow it to disturb the overall complexion or the allocation in the portfolio is something that we don't do. We follow an approach which is guided by, as far as the risk management is concerned, by our own internal risk template. And that's something that I've always had as a part of me ever since I started managing money, which was some time back.
Great. Thanks, Ashish and Sundaram. So I'm going to take some questions, and unfortunately time is also running. So I will, like you guys, if you can, make the answer quick so that I can take maximum number of questions. The first question is from the audience is that if I invest in a company with a 5-year view, but it runs up 100% within a year, should I exit or should I wait for the entire course of 5 years? How do you really, because these are the dilemma of investors, right? So they're just asking what can be a best approach to this situation. Anyway, Ashish or Sundaram, whoever.
I think after it has run up, I would reassess the situation at that point of time. Is it still at that price? Is it still a buy or not? Or is it still worth a hold or not? See, if the prospects continue to remain quite good, even beyond that 100%, there is no reason why you should sell at 100%. But if at 100% appreciation, if the valuations have gone way beyond long-term averages or way beyond the expected growth rate in earnings, or if you think that there is some new competition coming in that business, or where you see some some dark cloud, I think that is the time to book profit. So it's not a thumb rule. We have to see it, the situation at that point of time. It is very specific to that particular company at that point of time. So I would not like to generalize here.
I just like
thanks, Sundaram.
One point over here, Bharat, is that the thesis for which you bought the stock, as long as it remains valid, you continue to hold the stock. I mean, just because it has run up, I mean, you bought the stock because you expected it to run up, right? So as long as the thesis is intact, the valuations have not gone out of the whack, I think you remain focused and invested in the company. What I would do.
So the second question is for you, Ashish, is again a simple one. At most times, a multi-bagger comes to notice when it has already run up significantly. Since the market is gung-ho on a stock, there are just positive news around it. How can we evaluate entering into such companies?
So first and foremost, this is again a trading approach, which I've already, at the very beginning of this, discussion, I said one should avoid. The one thing for every investor first to look at is what is the valuation. I mean, when you look at a stock, first an alert that should be there is what is the valuation, and second, what is the earnings growth. So a company may be having a valuation which may look expensive on a standalone basis, but if the valuation relative to its earnings growth is still attractive, then a stock. So standalone valuation is not the right approach. What you do is basically take a look at it as relative to the earnings growth or the opportunity that the company, the business, the size of opportunity that it is there to capture. But as I said, after as somebody had written this, and I read it in a report, that when a stock is actually a part of a research report, that's when the world knows about it and it's already been discovered. The whole idea is that is to look at or identify. So there are close to 5,900 plus companies which are listed on the Bombay Stock Exchange. If you are going to look at a stock which has already been discovered, for which a research report has come out, then it is already late. Is what the article basically says. So the whole idea is to stay with experts.
Thanks. Sundaram, specific to you, again, a very interesting question. The Indian investors lives in a global village and they're surrounded by news of recession and rate hikes. It can be at a time be tough to believe the data, which shows market hitting all-time high. For a regular SIP investor, the decision-making might be easier at a time. But for a well-informed investor, such, dichotomy can create confusion. What would be your advice to such scenario?
I again repeat what I said in one of the earlier questions. When people talk of market, it is inevitably they talk about the index level, right? Now, there are parts of the market that are expensive. I'm not disputing that. And there are parts of the market that are not expensive. Good quality companies are available at not so expensive valuations even today. So our job as investors is to identify those opportunities. See, there are, as Ashish said, there are 6,000 listed companies in India. You obviously can't invest in all of them. So you have in your portfolio, maybe there are 20 or 25 of them. And out of 6,000, I am quite confident that we can find 25 opportunities that are not exorbitantly expensive. So yes, it's now a global village. World events will definitely affect India's economy. All that is true. But at the same time, opportunities also exist. Here is an economy that is growing at a real rate of 6.5% plus. Here is an economy that has, a country that is a young population, where there is, a great deal of opportunities to invest. Many emerging economies are restricted to 2 or 3 industries. India has got pharmaceuticals, it has got automobiles, it has got engineering, it has got financial services, it has got technology, it has got IT services, it has got media and entertainment. How many emerging economies do you have such variety? I am not saying that everything is gung-ho. I'm not at all saying that, but there are opportunities available. So that's the point. Instead of focusing on what the index level is, instead of worrying about what the US interest rate will do to India's economy, let's look at opportunities, individual company-wise opportunities. That is what I would suggest to your investors.
Great, interesting, and I'm just going to take a few more questions, but they are interesting one, and I want to take according to you guys, and I think you maybe prefer to answer in 1 or 2 without an explanation. According to you, what is the biggest wealth creator over a long period of time? Asset allocation, stock picking, time in the market, avoiding noise and biases, or pure luck? Ashish.
Well, it's a combination of all of these factors. I would not say it is just one of them. Asset allocation is definitely important. Stock picking is definitely important. Avoiding biases is definitely important. So these are not mutually exclusive. All of these contribute to a decent return over a period of time. That is my response to your question.
Ashish?
I would just add to that. You would have heard this line, and I'm sure others too, is that it's better to invest in the worst stock in a good sector rather than investing in the best stock in the worst sector. What does this line basically explain to you is that allocation is important. So allocation, selection, and time in the market. I agree with Sundaram. All these 3 aspects are important. At the end of the day, money managers or fund or portfolio advisors, their job is to be more sharp in terms of stock selection, and that's what we are here for. So and best thing to avoid, self-medication.
Great. And the last question to both of you: one book you will recommend for Indian investor that can help them understand this underrated aspect of investing. These are audience questions. So one book.
I think a recent one that which I enjoyed is the Psychology of Money by Morgan Housel. I think it's a remarkable book. It's not a very thick book. It's easily readable and it's filled with wisdom. I would suggest that.
Psychology of Money. Great. Ashish?
Well, I would suggest the best book to read, in my opinion, to understand investing would be Mahabharata and Bhagavad Gita. That's where I draw my inspiration, because there are a lot of things about my own investment philosophy which I have gained from the Bhagavad Gita itself. So, I mean, allow me just 1 minute, and you know, something that I would like to, you know, give as a story to explain or narrate this part. There was on the eve of, or just the day before the Mahabharata or Kurukshetra war, Draupadi asked Krishna about, you know, what is going to be the result of this war, who is going to win, what is going to happen, and to which he responded and he said that I have no idea what is going to happen, who's going to win, I don't know what is the future. She said, I can't believe it. He said, you know so much about the future. So his response to that was, I simply observe people, I see their behavior, and on the basis of their behavior, I am able to make a more informed guess about estimate about what is going to happen to them in their life. My observe, analyze, and invest philosophy actually comes from there. He very clearly goes on to explain, thoughts give rise to words, words give rise to actions, actions give rise to behavior, behavior is your nature, and that determines the future. Each and every individual at every second of his life is scripting his own future by his own thoughts. So we keep on wondering what is going to happen in the future. Well, I don't know. When Krishna himself says he doesn't know, how am I supposed to know? So my philosophy is very simple. I try to emulate what he did, which is observe, analyze, estimate, and come up with what is going to happen tomorrow. I use those principles even in my investing philosophy, which is observe, analyze, and invest.
Great, guys. Thank you. I think it was really, really engaging. And I think I'm sure our audience took away a lot of notes about this psychology of money and Bhagavad Gita. I think Bhagavad Gita, you can pick up any page and read, and obviously every time you'll find a different thought to do it. So I really do that sometime, but really not as often as you do, Ashish. But definitely, thank you, both of you. Thank you, Sundaram. Thank you, Ashish, for joining, spending time, enlightening all of us with entire concept of biases. And I think you guys have been very clear that nobody is wrong. It's all about discipline. It's all about the fact is that keeping the discipline of investment, purpose of investment, avoiding big mistakes, avoiding biases, avoiding the greed and fear to some extent. But the broad picture, what both of you try to paint is that there are no biases. It's a process of investment. Do the processes well, follow the processes. And if you do your things well at consistent speed, you will definitely come out as a winner. So thanks a lot. Thank you, Ashish.
Thank you very much.
Thank you, Bharat. And, you know, let me once again, you know, record my thanks to ICICI for this opportunity and for supporting us on your platform. Thank you.
Thank you, everybody. Thank you, Ashish. Thank you, everyone.
Thank you.
Thank you.